Investors, welcome to the High Class Dividend channel. In this video, I want to give you my watch list of discount opportunities I'm noticing in this moment. I'm seeing 24 companies ready to be bought as per my interpretation of the dividend yield theory. I want to show you how to gauge the market sentiment and understanding which stage of the market cycle we are in. And finally, I want to present you my dividend matrix and the concept of dividend potential. Lots of good stuff today, hope you like it. Please don't forget to watch my first two videos of this channel, they set the stage for this one. Disclaimer, this content is for educational and entertainment purposes only. I am not a financial advisor, nothing in this video is finance, legal or tax advice. Always do your own research and consult a licensed professional before making investment decisions. Okay, today we'll go through the metrics I'm tracking for my portfolio and we'll see why it is so important to create a watch list and how this helps us understanding the market mood. After understanding the current sentiment, I'm gonna walk you through the discount opportunities for this month and we're gonna dive deep on the dividends of one company through my dividend matrix. Currently, my watch list is composed by 72 companies and this changes slowly each day as I add new companies or older holdings don't qualify anymore for my strategy. Out of those 72, 24 are discounted in this moment. In the moment I record this video, that equivalates to 1/3 of the sampling. Actually, that's a record for me. Since I started tracking this metric of my watch list, I have never had such a high quantity of companies discounted. This is interesting because it's the opposite to what we see about the S&P 500, which some say could be overvalued in this moment. The point here is that my watch list is composed by only a portion of the companies present in the market index, but more importantly, my holdings are equally weighted for my calculations. The S&P 500 today has more than 30% of its weight given by the top 10 companies. To me, that's not a market index. But let's move forward on how we can gauge the market. This here is the dividend yield over time for my watch list, and it shows that the current yield level today seems to be a bit lower than the previous months. This could indicate the opposite of the last slide, as a lower yield indicates higher prices, but we are not finished. We have to check one more metric in order to get a better picture. Let's move on to the dividend growth rate. And here the graph tells us that we have never had such a low value since I started tracking it. To me, nothing says more about the future prospects of a company than the last dividend growth rate. Management would never increase dividends by a rate that cannot be covered by the growth rate of earnings in the next year. Now, there are exceptions to this, but setting dividend growth rates based on prospects of earnings growth is the rule. What this graph is telling me is that companies have never been this doubtful about future earnings growth. Okay, the sampling is small, but I'm working with what I have. Now, investors, we need to look at both yield and growth rate at the same time, and here's why. We have 4 areas in this graph: low dividend yield and low dividend growth, high yield and low growth, high yield and high growth, and low yield and high growth. These areas can represent the stages of a market cycle. When companies are delivering very high growth rates for earnings, stock prices follow together, lowering the dividend yield. So the high growth, low yield area could represent a bull market or the top of a bull market. Later on, management sees that things are not gonna be great forever and start lowering dividend growth rates in order to prepare for more difficult times. That's when we start to see a reversal towards a bear market. Then, share prices start to follow this lack of confidence on future prospects, increasing therefore dividend yields. Here we are nearing the bottom of a bear market. As time goes by, holdings understand that the worst is over and they start to perceive higher earnings growth, which sponsors higher dividend growth rates. This signals a reversal into a bull market until we reach the top again and the cycle starts repeating. I prefer seeing the cycles in this way in comparison to the classical sinusoidal wave we usually see. What we see here is not the absolute truth, but it helps us with our favorite metrics to gauge market sentiment. Now let's see where we are in this graph. Each blue dot here is the dividend yield and the growth for a specific month. The orange point in the bottom is the situation for the current month. This could signal we are in a bear market, but I don't dare affirming anything, as our sampling is very small, just a few months of tracking. My takeaway is that I want to be cautious, keep buying companies where I noticed bargains, and if I had a portfolio with a good amount of positions already, I would probably increase my cash position, expecting future discount opportunities. Before I move to the next slide with the discounts for this month, I want to remember you that you can check my portfolio live on eToro. The link is on the description. You could even automatically copy my portfolio and all operations I do. There's a link in the description to open an account if you like it. Finally, here are my bargains for this month. I won't go through all of them. You can pause the video and check each take your time. Here, there are low growth companies, there are high growth companies, there are companies struggling in this moment, and there are companies that haven't been discounted for a long time. For information, in this moment, my portfolio is composed by these two companies, United Health and L'Oreal. Now I want to give you some insights on how to analyze the dividends of a company. Let's talk about American States Water, one of the bargains I'm noticing currently. You already know from my previous video that this is my valuation graph, and we can see that AWR is scoring a very high level of dividend yield in comparison to its historical levels. This second graph here compares it with my watch list. The yellow dot is American States Water dividend yield and growth, and the lines are crossing on the yield and growth of my watch list. This graph is telling us that AWR represents a higher yield and more or less the same dividend growth rate as my watch list. We can see this better in the graph of yield on cost over time. Also, this one is known to you if you watched the previous video. American States Water not only starts at a higher yield level, it also increases faster. I use this comparison to determine the dividend potential for this company. I created this set of rules to gauge the compounding potential of a company dividends. AWR passes my watchlist yield on cost at year 5, it actually starts higher, and it has a dividend growth rate of 8%. Therefore, I judge it to be a high potential dividend. Now, why do I do this exercise? The reason is simple. My money is finite and the companies of my watchlist are competing for it. I want to put it where I'm gonna have the fastest dividend compounding I can get. This is another reason why it is so important knowing and tracking your watch list. It helps you choosing your next investment. Before I show you my dividend matrix, we need one fast slide about dividend safety. I'm gonna need a whole new video to explain my process for this one, but here I wanted to give you a taste of what it englobes and how I calculate it. I'll check if the business intrinsically can afford the dividend or if external cash is necessary, then how easy is the access for credit for that company, how much management is willing to increase dividends, the profitability of that company, and many other aspects. Here, just a tiny portion of the metrics I'll check. I put them here just to give you the message that not only the current number for the metric matters, but also the tendency. Companies don't die from one day to the other. Usually it is a slow process, and checking tendencies can give us good insights. For AWR, I assign a Dividend Safety Index of 8.43 out of 10. This is a safe dividend. From what I have been checking, my index seems to be more conservative than other famous ones on internet, so I'm happy because this gives me some confidence. So, we have seen that AWR presents a high dividend potential, This measures how fast it compounds its dividends in relation to other competing investments. We saw that it presents a safe dividend index. If we put them together in my dividend matrix, we'll see it falls in the dark green area, the best one. I like this matrix a lot because even though it is bidimensional, we are looking at three metrics here: dividend yield, dividend growth rate, and dividend safety index. But of course, this should not be enough in order to take an investment decision. An investor should balance it with what he already has in his portfolio and also determine the sizing for his position. I think I have some nice insights about these ones. Would you guys enjoy a video about this? Let me know in the comments. Okay, I end with what I call the dividend dashboard for AWR. We can see its valuation, the potential, and the safety. I think this company could be worth for your study. Would you want me to analyze the dividends for another company? Just let me know. And that's it. I hope you guys have liked this one. Please leave a comment with some feedback or requests for future content. Would you like to see more of my watch list, maybe my portfolio that have just started to build? Just let me know. If you can, leave a like and subscribe, and I'll see you in the next one.